According to the Community Financial Services Association of America, there are an estimated 18,600 payday advance locations nationwide that have extended $38.5 billion in credit to 19 million households. The simplicity of borrowing and the easy access to cash make payday lending appealing to many consumers, mostly those who have little or no access to conventional credit. Payday lenders rely on repeat customers, often low-income minorities, charging exorbitant compounding interest for cash advances. They seldom offer borrowers workable repayment plans and, in many states, operate with few regulations. Payday lenders advertise on TV, radio, online, and through the mail, targeting working people who can't quite get by paycheck to paycheck. Though the loans are advertised as helpful for unexpected emergencies, 7 out of 10 borrowers use them for regular, recurring expenses such as rent and utilities. Payday lenders offer cash advance loans, check advance loans, post-dated check loans, or deferred deposit loans. They almost never check credit histories, making their loans easy to get, but interest rates are extremely high, and customers are among the nation's least savvy borrowers. The Consumer Financial Protection Bureau, CFPB, a federal government agency, issued a report in 2014 that showed most payday loans are made to borrowers who renew their loans so many times they end up paying more in fees than the amount they originally borrowed. The average payday loan borrower spends $520 in fees for what originally was a $375 loan. Despite the well-documented consumer hazards, the U.S. payday loan business thrives in states that don't put caps on interest rates. In 2008, a Dartmouth economist said there were more payday loan outlets than McDonald's restaurants and Starbucks coffee shops combined. But there are signs the business is in retreat as an increasing number of states have imposed rate caps. The Pew study said the number of states where payday loan lenders have operations dropped from 44 in 2004 to 36 in 2015. The decline in operations has cut deeply into the payday loan business. The nonprofit Center for Financial Services reported a steep decline in the storefront loan business that began in 2013, with revenue falling 23.4% from 2014 to 2015 alone. Revenue also fell by 22.5% for non-bank online payday loans in the same period. But as payday loan revenue declines, issuers of subprime credit cards have made big gains, keeping the level of all subprime consumer lending relatively constant in the past several years. How do payday loans work? Getting a payday loan can be deceptively easy. You simply walk into a store with a pay stub, ID such as a driver's license, and a blank check from your checkbook. The stores often double as pawn shops. The clerk will offer a small amount, typically $100 to $500, that is due when you're paid next. You will commit to paying what might sound like a reasonable amount, say $15 for every $100 borrowed. The lender will demand you make out a post-dated check to cover the loan plus fee and tell you that the check will be cashed at the end of the loan period, usually 2 weeks. Sometimes they will ask you to provide an authorization to electronically withdraw money from your bank account. When the due date arrives, cash-strapped people quickly discover that they need every dollar from their next paycheck to cover living expenses, so they return to the lender and ask for a repayment extension. This can add up quickly. Payday lenders are subject to the Federal Truth in Lending Act. It requires that lenders disclose the cost of the loan. Payday lenders must disclose the finance charge and the annual interest percentage rate, APR, in writing before you sign for the loan. Though payday lenders commonly operate out of storefronts, a newer class of loan operator uses the internet. Some offer loans directly, others are information brokers that ask questions and sell what they gather to lenders. Financial experts say online lenders can be risky. They might offer a loan, but you can't be sure if they will use your information for other purposes, potentially opening the door to scam artists. Many of the online sites are information brokers, which gather your financial data and sell it to lenders. Cost of payday loans. Borrowing costs can soar astronomically in a short amount of time. Cash-strapped borrowers will often return to the lenders, saying that they don't have the money to repay the loan, something lenders actually like to hear. They will offer an extension, known as a rollover, that will give you another 2 weeks to repay the loan with the caveat that you must pay another fee. After the first rollover, you will owe $30 in addition to the $100 you borrowed. After 6 months, the fees will hit $180 plus the principal, leaving you with a debt of $280. Borrowers can easily get caught in a debt cycle, taking out additional payday loans to repay old ones, all the time sinking deeper into financial quicksand. Payday lenders' prime customers have long been poor people and military personnel. Payday lenders used to set up shop just beyond the perimeter of military bases, gouging soldiers and their families. To stop the practice, a 2007 federal law capped annualized payday loan interest at 36% for active duty service personnel and their families. Not surprisingly, the lenders are moving elsewhere. Reasons to avoid payday loans. Think before you borrow, remembering the financial pitfall implicit in payday borrowing. Payday loans are very expensive. High-interest credit cards might charge borrowers an APR of 28 to 36%, but the average payday loan's APR is commonly 398%. Payday loans are financial quicksand. Many borrowers are unable to repay the loan in the typical 2-week repayment period. When it is due, they must borrow or pay another round in fees, sinking them deeper and deeper into debt. Borrowing from short-term lenders is too easy. Unlike bank loans and credit card accounts, payday loans don't require extensive paperwork. You can get one just by walking into a store, signing some papers and writing a check. And unlike other loans, once you sign the papers and take the money, you can't change your mind since the loans commonly don't contain a right of recession. Some payday lenders want the right to access your bank account. They say it will save you the hassle of writing the commonly used post-dated check. But if the loan comes due and the funds aren't in your account, the payday lender can make repeated attempts to withdraw the money, often resulting in multiple overdraft charges of $35 or more. Payday lenders can be ruthless debt collectors. If you can't repay the loan, prepare for a barrage of tactics that includes late-night calls from debt collectors.